Hello and welcome. This is going to be a short tutorial going over a problem S16-3 from the Pearson textbook. It is fairly straightforward, so it is a good way for us to limp into the chapter 16 content. So let's see what we've got here. We've got Allcorp who completed the following investment transactions, during 2019 and 2020. And then they have transactions here. So I'll read those in a minute. I know I'm likely going to have to do journal entries for them. So I'm going to read them as I do the journal entry, and then we'll just see what's required. So classify them as either short-term or long-term, and then journalize all of these investment transactions. Explanations are not required. All right, so let's look here. What's happening? On December 12th, 2019, they purchased 1,500 shares of Blackmore Limited at a price of $62 per share, intending to sell the investment within 1 year. And it looks like I've actually gotten some information that's hidden. There we go. Brokerage commission fees were $510. All right, so requirement number one asked us to classify investments as short-term or long-term. Remember the rule of thumb. If it is within 12 months, less than 12 months, it's a current asset. So it's going to be categorized as a current asset on the balance sheet. Here, it told us they intend to sell investment within 1 year. So here they're speculating that the share price is going to be appreciating within the next 12 months. There's going to be a short-term return and they intend to sell it. So it's management's intention on whether they intend to hold or sell that dictates whether it will be a short-term or long-term investment. It'll be a short-term investment if it's intended to sell within the next 12 months, which means it's going to be a current asset. So the answer to requirement number one is short-term. And then requirement two is to do the journal entries for all of the transactions. So let me just put the date here for the very first one, December 12th, 2019. So what do we have? We have one organization that's buying, they purchased 1,500 shares at a price of $62 per share. So they're buying 1,500 shares at a price of $62 per share. So their total investment here is going to be those two numbers multiplied together, which is a number that is far too complicated for me to do in my head. So I'm going to use Excel in order to calculate that, which is $93,000. All right, so they have a short-term investment. That's what they purchased. And the value of that short-term investment is going to be 93,000. The brokerage commission fees were $510. So that comes as an expense on the income statement. Brokerage fees expense, brokerage commissions expense, one of the two is 510, and they bought the shares by paying with cash. So cash is going to decrease by the combined effect of those two. So this is the journal entry for for the December 12th transaction. Then let's see what happens next. On December 21st, they received a cash dividend of 48 cents per share on the Blackmore Limited shares. All right, so we know that investors buy shares for really an appreciation in share price or to receive dividend payment. They're looking for they're looking for income. Not fixed income. Fixed income refers to bonds, but they're looking for an income stream in the form of dividends. So here they received a dividend in the amount of 48 cents per share. This is from the investor's perspective. So remember, they bought the share, they are receiving the dividend. Because they are receiving the dividend, cash for them is going to go up. So on December 21st, 2019, what's going to happen is cash is going to go up for this organization, for Allcorp, in the amount of 48 cents per share, multiplied by the 1,500 shares that they purchased. And this is going to be just under $750, 0.48 by 1,500, $720. So cash for them is going to go up by $720 because they earned dividend revenue. This is dividend that they receive, so we need to keep our perspective straight. In previous chapters, we've talked about the journal entries for the issuance of a dividend. Now we're looking at it from the perspective of receiving a dividend. So this dividend revenue is going to increase income on the income statement. And of course, it increases cash on the balance sheet because it is a receipt of cash. So we've got December 12th and December 21st. What happens next is adjusted the investment to its fair value of 61.50, and this is at its year-end date. So remember, with short-term investments, we do the fair valuation method, which means that at year-end dates, we adjust it to the fair value so that our balance sheet is accurately reported and is a real reflection of the market value of the shares. So on December 31st, these shares were worth $61.50 per share. We bought them, remember, for $62 per share. So this organization has what's called an unrealized loss, right? The purchase price here was $62, per share. Its current value, I believe it was $61.50 per share. So on a per share basis, they've lost 50 cents in value. They've depreciated. So what we need to do is we need to recognize an unrealized loss, an unrealized investment loss. So what we have to do here is calculate the total value of the loss. We have it here. This is per share. But remember, they bought 1,500 shares. So 1,500, and of course I get a phone call, my apologies about that. Let me just put that on mute. They have 1,500 shares, and they have a 50-cent per share loss, which means in total, they have an unrealized loss of $750. I'm going to debit this to an unrealized loss on fair value adjustment of $750. The credit here goes to what is called a fair value allowance of $750 as well. And sometimes it's actually called fair value valuation or fair value allowance. I believe the textbook calls it fair value valuation allowance. This fair value valuation allowance, or I'm just going to abbreviate that to FVVA, is a companion account to the actual investment. So you use it to either offset or add to the investment account to determine the carrying amount of the investment. In this example, we have a short-term investment that we recognized a journal entry for right at the very first transaction, December 12th, 2019. And I'm going to post that to a T account. And I'm going to do that as a T account down here. I'm just going to call it investment, though, to save time. And the amount of the investment was $93,000. We recognized at year end, though, because we adjusted to its fair value, we recognized this this fair value valuation allowance. So I'm just going to say FVVA, which currently has a credit balance, $750. Notice here how our investment has a debit balance, and our fair value valuation allowance has a credit balance. Currently, because they have a different balance, I am sorry about that, excuse me. Because they have a different balance, they offset each other. So the actual carrying amount of this investment is going to be the 93 minus the 750, which is 92,250. So that's the carrying amount of this investment as of December 31st, 2019. So this is the amount it would be reported on. Amount reported on balance sheet at 2019 year end. Okay, I think we're done. Is that it? No, I'm sorry. There's one more transaction, January 16th, 2020. What do we need to do? All right, so let me read this problem here. They sold the investment for $59 per share, less brokerage commissions of $490. All right, so what I like to do with problems like this, where we're now selling an investment that we own, is start with what is easy. What is easy is, well, there's a couple of things that are easy, actually, right? It should give you confidence. But what is easy is recognizing that you need to reduce all of your accounts related to this investment to zero. You have your investment account that we posted 93,000 to as a debit, and we have our fair value allowance that we posted to as a credit. We need to reduce those to zero. We don't need to do anything with this unrealized loss. We don't reduce that to zero because this is on the income statement. We're reducing all of our balance sheet accounts related to this investment to zero. So let's start. I'm gonna credit not this investment account by 9,000. And I think I called it short-term investment. So I should be consistent with my names in my journal entry. Short-term investment, 93,000. I'm going to credit that. I'm going to debit my fair value allowance by $750 to reduce that to zero. Okay, so I've debited this by $750, which now means it's zero. And I've credited this by 93,000, which now means it's zero. So what's left is, or it should at least be easy to recognize, if they're selling this, they're getting cash for it, right? Cash is going to go up. And they have this brokerage commission of $490. So the brokerage commission is an expense that's going to show up on the income statement. So I could start with that next. I could say, you know what, my brokerage expense, or my brokerage commission fee, or whatever I want to call it, is that's going to show up in the income statement. And I believe it was 410. No, it was 490. 490. And of course, they are going to get cash. Or they're going to get cash for selling this investment. Now, let me see here. They sold it for $59 per share, and they had 1,500 shares. So they're going to get cash of $88.5. But what we do is we minus the brokerage fee that we need to pay, because they're not going to collect that cash. So they're going to collect the 88,010. They have to pay their broker $490 to execute that transaction. So the broker's just going to keep that for themselves and give them the difference. If I were to do this and sum up my debits and my credits here, I've got a problem. My problem is that my journal entry doesn't balance. It doesn't balance because we sold it at a loss, right? We sold it at $59. But our balance sheet last year says that it was worth $61.50. So we experienced another loss on it, $61.50 minus $59. And this is going to be what? $2.50 per share is lost on this transaction. So let's try that out. I'm going to do equals 2.5 times 1,500. And that brings my journal entry into balance. And this is going to be the loss on sale of short-term investment. I'm going to debit this loss. So what I want, and I should make sure that we're done this problem now. Yes, we're done. So what I want to point out, I want to pause for a minute here and take a look at this problem. and point out a couple of things. This unrealized loss goes on the income statement. So when I said we reduce our accounts to zero, I meant we reduce our balance sheet accounts to zero, which means the allowance in the actual investment account. So that's one thing. Another important thing to recognize is that we recognized this loss, this loss of 750 last year. The total loss on the investment, if we look at this from a total perspective, year or cumulative from date of purchase to today, the total loss was $62, and they sold it for $59, which is a loss of $3 per share. And they owned 1,500 shares, which is a total loss of $4,500. Now, I did that math in my head, so I hope it's correct. We'll be able to figure that out very soon, though. So they experienced a total loss of $4,500. Remember, part of the income statement is that we recognize revenues and expenses in the period they are incurred, or in the period revenue is earned, or the period the expense was incurred. So losses and gains should follow that general rule as well, right? It stands to reason. So what we did is we recognized $750 as a loss on the income statement in 2019 because the shares dropped in price by that amount in 2019. And then what we have is in 2020, a loss of $3,750. And that's in the 2020 income statement because that loss occurred in 2020. Now, if I were to add these two numbers together, I'm hoping that's right, but I think it is, just looking at it. That's going to be the total loss experienced by owning these shares. The total loss is $4,500. We allocated that loss between 2 years because the loss was spread out over a 2-year period. Even though we didn't sell it in 2019, we recognized that unrealized loss on the 2019 income statement. Okay, so this is problem S16-3. I hope that you found this tutorial useful. If there's anything I can do for you, as always, please feel free to reach out. All right, thank you so much. Take care.